Welcome to Confident Real Estate. I'm your host, JC. We're going to get right into it today. I'm going to talk about the difference between commercial real estate investing and residential real estate investing because they're very different. Even though they're both real estate investments, commercial real estate and residential real estate are essentially totally different animals in many, many ways. And it's important for you to understand the difference as you start to get into real estate investing yourself. If you don't know what it's all about, well, that's why we have this channel. And if you're not part of the Confident Real Estate family, you better hit that subscribe button right now. And of course, I know you're going to find this information helpful, so go ahead and hit the like button right now to feed that YouTube algorithm. Otherwise, there'll be an opportunity for you to do it at the end of the video. So stick with me because I'm going to cover a lot of really important things in a very short time frame. We're going to cover the difference between commercial real estate and residential real estate investing, how the capital appreciation change between the two different asset classes can be so significant, because in commercial real estate you can really control the capital appreciation much more than you can in residential real estate, and I'll explain why. And we're going to talk about net operating incomes, NOIs, and cap rates. Very simplified, straightforward explanations. So let's get into it. It may seem obvious, but let's just clarify right up front. What is residential real estate versus commercial real estate? Residential real estate is residential. It's where somebody lives. You buy a 1 family, 2 family, 3 family, 4 family, and people live there. It is their residence. It is their residence, which makes it residential. Commercial, there's a variety of different asset classes. It could be hospitality, meaning hotels. It could be something in the entertainment sector, like restaurants. It could be industrial warehouse property. It could be mixed use, meaning multifamily, residential, above a retail storefront. It could just be retail all by itself. Or it could be just multifamily, which again is apartments and residences. What differentiates multifamily commercial real estate from residential real estate is the number of units. A residential property is deemed to be a 1 to 4 family property, and that will qualify you for a residential mortgage, which usually comes at a lower rate, not always, and you really don't have room to negotiate the loan documents. You're probably going to go for a government insured loan. You might get a higher amount of money compared to the amount of actual cash equity you need to put into the deal. Maybe you'll get an 80% loan to value ratio. If you're going to occupy one of the units and do some house hacking, where you live in one unit, say it's a 4 family, you rent out the other 3, well then maybe you can qualify for an FHA loan and put down as little as 3%, 5%, and get financing for the rest. When it comes to commercial multifamily, that's residential property that has usually 5 units or more. So if you're buying a 10-plex that's going to have 10 units, that's going to be a commercial property, and you're going to qualify for a commercial loan. The benefit of that is that you can buy it in an LLC much easier, and you can bring in other people as investors who become members of that LLC, and we covered some of that in another video about whether or not you need an LLC, and I'll leave the link to that video down below. But essentially, that's the major difference. And your cash flow will dictate a lot more of the value of the property in commercial real estate than in residential, because in residential real estate, even if you have, let's say, a 2 or a 3 family, a lot of people who buy that property are going to actually want to live in one of the units. Not all the time, but most of the time. Personally, that's what I've found as well, that when you have a 2-unit or 3-unit property and you go to sell it, the biggest unit should be vacant, because that's what the subsequent purchaser is likely looking for. Otherwise, you're narrowing the pool of people you can sell to just other investors who are interested in residential multifamily property. So your residential purchase and investment is going to have value that's determined by the location it's in, to a degree, the cash flow you're getting, the quality of the property, whether it's been kept and maintained in good order, and what the capital appreciation growth is of the area that it's in. Commercial real estate is very similar in that it's going to have a lot of those same factors, where your value is going to go up based on job growth, population growth, income growth in the general area that the property is located. However, there's also a different factor called the cap rate and your net operating income. Those are factors in residential real estate, but in commercial real estate, you have the power to really change those numbers and have it make a huge difference on the value of your property and the amount of money a bank will give you for the property and the amount of money that a subsequent purchaser will pay you, another investor will pay you for that property. Because at the end of the day, in commercial real estate, the people who will come to buy it from you down the road after you've owned it for a while and built up some value in it are other investors. They're not people who are going to live there. They're commercial real estate investors. They're not like residential purchasers who may want to actually live in the biggest unit and just rent out the others to help subsidize their mortgage payments. And that is a huge consideration that you should make when you're deciding whether to buy, say, a 5 or 6-plex versus a 3 or 4 unit. Because you might have a tremendous swing in value based on whether that property qualifies as residential or commercial. So what's a net operating income, the NOI? Well, a net operating income is essentially the amount of cash flow you're going to have when you take in all the rents that you're going to collect on the property, and then you consider things like insurance, real estate taxes, property maintenance, any landscaping, snow removal, things that are required to maintain the property in good order and really maintain the asset and the value of the asset that you're investing in. Once you deduct all those expenses, then you will have your net operating income, but you have to also take into account your debt service, which is the amount that you have to pay back on your loan every month. If you have a fixed rate loan, you know what that's going to be and you can plan for it for the entire amount of the term of your loan. If it's going to be a variable rate loan that's going to adjust, then you have to account for what that could be as well and maybe plan some other cushions. You're going to have reserves, possibly for tenancy turnover, you should, and also a reserve for potential capital improvement projects because like any property, things break down, things get old, you need to replace them. So put that money aside every month out of the rents. Whatever's left, that's your net operating income. That is your cash flow. And it's going to go to pay down your mortgage and your debt service, and it's going to go in your pocket, the remainder of it. So be aware of it. Some people calculate net operating income without calculating their debt service payments on the mortgage. I personally calculate that in as well, so I know what my actual cash flow expectation is every single month. And that's your NOI. Now, why is that important to understand? Because it plays significantly into cap rates. And cap rates play significantly into the value of your commercial property, not as much on the residential side. So what's a cap rate? Good question. A cap rate is the amount of profit you could expect, your investment return in a 1-year time frame. So if you're going to go buy a property, and now commercial properties are sold for the most part with cap rates advertised as part of the sale, because that's to entice investors. And again, the cap rate takes into consideration all of those expenses that are part of the net operating income, but not the financing cost, your debt service. You got to calculate that in as well, because only you know what type of loan you're going to get, what the interest rate on that loan is going to be, and the terms of the loan. And again, remember, commercial loans can be negotiated, whereas residential government-backed loans really cannot be negotiated. They're heavily regulated. Commercial real estate has a lot fewer regulations because you're deemed to be, in the eyes of most courts around the country, an educated investor if you're investing in commercial real estate. So there's not as many restrictions in place as there are for anybody who's going out to buy a home to protect those people who are investing maybe just to have a home for their family. Just be aware of that. Calculate in what your mortgage payment's going to be, and that will give you a real sense of what your net operating income is. But when you go to buy a commercial property, they're going to advertise a cap rate. And let's say you're buying $1 million property and they tell you that after all expenses and all rents collected on the current rent roll, they are averaging $100,000 in profit every year. Well, that's a 10% cap rate. That is phenomenal. In the Northeast, where I live and invest, cap rates are usually somewhere in the 5 to 7% range, depending on where the market is. So, Just calculate that in, calculate what your mortgage debt service payments are going to be, and that'll give you an idea of what your cash flow is. However, when you're buying a residential property, the value of the property is really going to be based on what a residential purchaser is willing to pay based on the jobs that are in the area and the economic growth of the area, etc. All the things we've covered earlier in this video and in other videos. Again, if you're not a member, click subscribe right now because you're missing out on a lot of great information. So, in commercial property, if you're able to lower some of those expenses and do some basic cosmetic capital improvements or make some additions and alterations that are simple enough to the property to provide value to your tenants, then you can gradually increase rents. Maybe as each unit vacates, you're going to go in and update it because every unit looks like 1982 and you want to bring them into the 21st century and have the units look like 2022. So, if you're able to do that and bring those rents up while bringing some of the expenses down, maybe putting in some mechanical systems that are more current and save energy, that will increase, it will decrease your expenses, increase your cash flow, and overall increase your return. And that return is your cap rate. In residential investing, that's important. But it's not going to be a determining factor as much in the value of your property as it will be in commercial real estate. Lowering your expenses and increasing your rent roll in commercial real estate is asset value that can be equated into the value of the overall property. And now maybe that property isn't worth $1 million, it's worth $1.2 million. And you can do a refinance and take additional equity, 6 figures, maybe $200,000 worth of additional equity out of the property and go buy another one. Or you could just put it in your pocket. And the best part is your tenants are going to pay back that loan for you. And because it's a debt that has to be repaid, it's not income. So you know what you pay in taxes on that $200,000 you just put in your pocket? 0. Do I have your attention yet? I really hope you understand the tremendous benefit of commercial real estate investing over residential. Now, don't get me wrong, most of us, myself included, we start in residential real estate investing because it's an easier beginning pool to get into for investing. You get your feet under you, you get some experience, you get your confidence, and residential real estate doesn't take the amount of money that commercial real estate takes because it does cost more to get into commercial real estate. I'm not saying you can't do it off the bat, you certainly can, but there's nothing wrong with starting in residential real estate investing. But when you get to the commercial real estate level, there is a lot more profit to make because consider this, if you go out and every 24 months, at the worst, you're buying another commercial property, maybe every 12 months, and you've been doing this for a decade, collecting cash flow, lowering expenses, increasing rent roll, collecting that bigger net operating income and increasing your cap rates on every one of your properties. Well, suddenly a decade will go by and you'll have 5 to 10 properties at least. And now you can go and refinance them, one every year. And if you're pulling out 6 figures from each of those properties that's tax-free, then you can go buy another 10 properties between what you've made in cash flow and what you've taken out in equity value that you've added to your properties that through cash out refis that you can then go spend on other properties. And suddenly you've got 20, 30 properties with hundreds and hundreds of units paying you cash flow. And all because you've figured out how to find properties that are poorly managed, lower the expenses, increase the rent rolls, and really take advantage of the cap rate value add that commercial real estate provides you. I appreciate you watching this video to the end. I hope you got something out of it. If you want to learn more or you have more questions, leave me some comments in the comment section down below. Leave me some questions. I'm happy to follow up. Smash that like button because I really do hope you liked this video and got something out of it. Hit that subscribe button if you're not yet part of our Confident Real Estate family. Otherwise, until next time.